Hi, welcome to Sectors Up Close. I'm Angeline Ong. Our focus today is on tech stocks and our guest is Max Grinacoff, equity derivatives strategist at BNP Paribas. Now, tech stocks have had a roller coaster ride over the past few days and weeks, as measured by the S&P 500 Communication Services and Information Technology Index. Large cap tech stocks were pummeled on news of the Omicron variant as investors fled these high-priced growth stocks and piled into defensives, only then to roar back to life as it became clearer to many investors the variant was unlikely to knock the global economy. But this is a basket of companies that outperformed since the start of the pandemic, as they were mostly immune to or even benefited from lockdown restrictions around the world. They include IT companies such as Apple and Microsoft, as well as communications firms such as Alphabet and Netflix. Their outlook has also been clouded by the prospect of tighter monetary policy and concerns that higher interest rates will prompt investors to rotate into so-called value stocks. So for his take, I'm now joined by Max Grinacoff from BNP Paribas. Max, thank you so much for joining us. I guess first off, what is your view, your take on the reaction for tech stocks when the announcement of Omicron came?
Yeah, thanks again for having me. So we actually published a note earlier this week in which we highlighted how the risk off was very much about positioning and the suppressed volatility backdrop leading up to the event, especially in the midst of a lower liquidity environment around the holiday. So things like call option volumes were very elevated. ETF inflows were strong through November, both of which we saw have been more recently correlated with market moves, which tends to suggest more of a trend following mentality amongst investors. So that said, we saw the spot up, vol up dynamic emerge heading into the correction, particularly in tech and growth oriented sectors. But it's not the first time. Think January of this year and even back to the tech melt up in August through early September 2020. But what we've seen more recently, as you allude to, is the market frothiness, as we refer to it, quickly being washed out, and then a subsequent recovery in risk assets over the past few sessions.
So with that as a backdrop, let's throw this forward. Where do you sit on growth versus value?
Yeah, so I would say, speaking more broadly, we have this 2022 year-end S&P price target of 5,100. That's around 9% from higher from current levels. The key driver for this is what we think could be continued strong earnings growth on an above consensus macroeconomic growth outlook. In terms of the tech and growth space in particular, we think a previously large headwind in the form of corporate tax hikes could likely be off the table in the second fiscal package. A minimum corporate tax is more probable in our view, could still have an impact, but I would say less so at the aggregate index or sector level. Another point to note is buybacks. That's been a key theme for us this past year. So worth noting that the tech sector in particular has accounted for roughly 25% of completed buybacks last quarter, consistent with previous times this year. And quickly just touching on earnings, what we saw post Q3 earnings season was growth-oriented sectors actually seeing weaker earnings momentum and value-oriented sectors conversely seeing the strongest. So it'll be interesting to see if that continues heading into Q4 earnings.
Let's focus on report cards now for the tech sector. Does the earnings momentum justify the prices going forward?
Yeah, so exactly what I just mentioned. I think what we saw post Q3 earnings season was earnings momentum slowing considerably at the index level from the strong levels you saw in Q1 and Q2 of this year. But what was most notable was earnings were actually revised slightly lower in aggregate for things like the NASDAQ 100. That was driven by areas like software that we saw. Whereas, as I mentioned, value-oriented sectors were actually seeing the strongest upgrades. But what we really like to focus on in our desk is screening for names seeing the strongest earnings momentum within the broader large cap universe and juxtaposing those names against lower quality corporates. So like I said, Q4 earnings season kicks off less than 5 weeks. Will definitely be interesting to see whether that divergent momentum in growth-oriented areas persists.
And what would you say are the biggest risks to the sector? Is it inflation? Is it Fed policy?
Yeah, so of course, December FOMC next week. Our rate strategy team expects, the Fed to announce an accelerated timeline, as Chair Powell, of course, alluded to last week. So that is tapering finished by March, and subsequently the potential for a first rate hike in June, per their view. But from an equities perspective, the Fed adjusting policy faster or by more than expected is not really in and of itself impactful to equities broadly or to growth in particular, in our view. It of course becomes more of an issue if this is done against the backdrop of higher risk of a slowdown, whether that's triggered by concerns around the virus or otherwise. So that said, we've highlighted several points over this past year. It's really the speed at which the market prices in these adjustments rather than the level of rates that becomes more impactful to things like the growth space in particular, similar to what we saw in Q1 of this past year.
Thank you very much. That's Max Grinacoff there from BNP Paribas. Now, before I go, here are some of the top stories in this space. Italy has fined Amazon $1.3 billion for alleged abuse of market dominance in what is one of the biggest penalties imposed on a US technology company in Europe. Italy's antitrust watchdog said in a statement that Amazon had leveraged its dominant position to favor the adoption of its fulfillment by Amazon logistics service by sellers on its Italian website. In addition to the fine, the authority also said it would impose corrective steps that will be subject to review. Amazon said it strongly disagreed with the decision and would appeal. The European Commission has announced draft rules to give workers for companies such as Uber and Deliveroo employment rights and benefits. Unions have argued the changes are long overdue, but the companies say it could lead to job losses. The draft rules will reclassify gig workers and employees entitled to minimum wage. The proposal needs to be thrashed out with EU member countries and lawmakers before it can become law. And finally, 3 US senators, 2 Democrats and a Republican have announced a bill to require social media companies, including Meta platforms Facebook, to give researchers access to their data. The bill, announced by Senators Chris Coons, Amy Klobuchar and Rob Portman, would require companies to release internal data and assist researchers approved by the National Science Foundation, which is a federal agency. Companies that fail to do so could lose their immunity under Section 230 of the Communications Decency Act. The senators said they hope that access to the data would improve transparency and scrutiny of big tech. And that's your roundup of the tech sector. I'm Angeline Ong, and this is Reuters.